Markets brace for presidential election, Fed meeting. What to know this week? As the world watches with bated breath, financial markets brace themselves for a week of high-stakes drama centered on two monumental events: the upcoming presidential election and the Federal Reserve's crucial meeting. These events promise to shape the economic landscape, leaving investors, policymakers, and citizens alike on edge. The presidential election, a cornerstone of American democracy, brings with it a wave of anticipation and uncertainty. Each candidate's policies on taxes, healthcare, and trade will have profound impacts on the economy, influencing market behavior and investor sentiment. The incumbent administration's policies, whether perceived as business-friendly or otherwise, set the tone for market expectations, while the challenger's promises introduce a spectrum of unknowns. Markets historically dislike uncertainty, and the lead-up to an election often sees increased volatility as investors grapple with potential policy shifts. Simultaneously, the Federal Reserve, the central banking system of the United States, is set to convene. The Fed's mandate to ensure maximum employment and stable prices makes its decisions critically important for the economy's overall health. This particular meeting comes at a time when the economy is still navigating the aftermath of the COVID-19 pandemic, facing issues such as inflation, supply chain disruptions, and uneven economic recovery. The Fed's stance on interest rates, quantitative easing, and other monetary policies will be scrutinized closely. Any indication of a shift in policy, whether towards tightening or loosening, could have immediate and far-reaching effects on financial markets. Investors will be looking for clues about the Fed's plans to manage inflation and support economic growth. Adding to the complexity is the intricate dance between fiscal and monetary policy. The presidential election results will shape fiscal policy direction, which in turn influences the Federal Reserve's approach. For instance, a government inclined towards increased spending on infrastructure or social programs could spur economic activity, but also necessitate careful monetary management to prevent overheating. Conversely, a more conservative fiscal stance might require the Fed to take a more proactive role in stimulating the economy. This interplay highlights the importance of both events and their combined effect on the economic outlook. Market participants are preparing for various scenarios. In the equity markets, sectors such as technology, healthcare, and energy may see differing impacts based on the election outcome. For example, a policy favoring renewable energy investments could boost stocks in that sector, while traditional energy sectors might face headwinds. Similarly, healthcare stocks could react sharply to proposed changes in healthcare policy. Bond markets are also on high alert, as changes in fiscal policy and the Fed's decisions on interest rates directly influence bond yields. Higher interest rates, for example, typically lead to lower bond prices and vice versa. Currency markets, too, are poised for potential fluctuations. The US dollar's strength is influenced by interest rate differentials, trade policies, and overall economic confidence. An election outcome favoring protectionist trade policies might lead to a stronger dollar, while policies promoting international trade could have the opposite effect. Furthermore, the global context cannot be ignored. The US economy is deeply interconnected with the global economy, and significant policy changes have ripple effects worldwide. International investors and governments will be watching closely, as US fiscal and monetary policies can influence global trade dynamics, capital flows, and economic stability. Emerging markets, in particular, may be sensitive to changes in US interest rates, as higher rates could lead to capital outflows and currency depreciation in these economies. Investor sentiment, a crucial factor driving market behavior, is being shaped by a mix of optimism, caution, and speculation. Surveys of investor confidence, volatility indices, and trading volumes provide a snapshot of current market sentiment. Increased trading volumes and higher volatility indices often signal heightened uncertainty and the possibility of significant market movements. Financial analysts and economists are offering varied predictions, with some advocating for a cautious approach, while others see opportunities in the volatility. To navigate this turbulent period, investors are employing various strategies. Diversification remains a key principle, spreading investments across different asset classes to mitigate risk. Hedging, using financial instruments like options and futures, helps protect against adverse market movements. Staying informed and agile is also crucial, with investors closely monitoring news, economic indicators, and expert analyses to make timely decisions. This is a time for prudent risk management and strategic planning. The broader economic implications of these events extend beyond the immediate market reactions. The policies and decisions made this week will set the tone for the economic environment in the coming years. Issues such as income inequality, climate change, and technological disruption are all on the table. The election outcome and the Fed's policy stance will influence how these issues are addressed, shaping the economic landscape for future generations. As we approach this critical week, it is essential for all stakeholders to stay engaged and informed. The convergence of the presidential election and the Federal Reserve meeting represents a pivotal moment for the economy and financial markets. Whether you are an investor, a policymaker, or a concerned citizen, understanding the stakes and preparing for various outcomes will be crucial. This is a time of great challenge and great opportunity, where informed decision-making can make all the difference.